Every few years, the market falls in love. .com websites in 1999, housing in 2007, crypto in 2021, and right now, artificial intelligence. AI stocks have gone vertical. A handful of companies have added trillions in value in a matter of months. And so the question everybody's asking is the right one to ask. Is this a bubble about to pop or the early innings of something huge? Here's the honest answer most people won't give you. It can be both. And today I'll show you how to tell the difference, what actually matters and happens to your money if it bursts, and the 3 mistakes that could cost investors the most when a hot sector cools. This is Stocks at Sunrise. What a bubble actually is. First, let's define the word. Because people throw it around carelessly, a bubble isn't just a price going up. A bubble is when the price detaches from the underlying value. When people are buying not because the business is worth it, but because they expect someone else to pay more. The tricky part, bubbles usually form around something real. The internet really did change the world, and .com bubble still wiped out 3/4 of the NASDAQ. Both things were true at once. The technology was revolutionary, and the stocks were wildly overpriced. AI can be exactly the same story. So is AI real? That is the wrong question. The right question is, are these specific prices justified by these specific businesses? The 2 signals that matter. There are 2 numbers that will tell you whether a hot sector is priced on reality or on hope. You don't need to be an analyst to check them. Signal number 1, are the profits real or just promised? In the .com era, most companies had no earnings at all. Just stories. Some of today's AI leaders make enormous, genuine profits right now. Others are valued on revenue that they hope to earn years from now. The distinction is everything. A company minting cash today is far firmer on its ground than one selling a vision. Signal number 2. What are you paying for each of the dollars of earnings? That is the price to earnings ratio. When a stock trades at, say, 15 times earnings, the market is fairly calm about it. When it trades at 50, 80, even 100 times earnings, the market is pricing in years of flawless growth, and any stumble will get punished and punished hard. High multiples aren't automatically wrong, but they leave little room for error. Run those 2 on any AI name and you'll quickly see which ones are priced for reality and which are priced for a miracle. What actually happens if the AI bubble pops? Say it does burst. What happens to your money? Well, this is where history is genuinely useful. When the .com bubble burst, the overpriced junk companies with no profits mostly went to zero and never came back. But the real businesses, they survived. Amazon dropped over 90%. And then went on to become one of the most valuable companies on earth. The crash separated the stories from the substance. That's the pattern. When a hype sector corrects, the companies with no real earnings tend to vanish and genuinely strong businesses get cheaper, albeit temporarily, before recovering. Which means a pop isn't the end of the world if you own quality. It's terrifying if you own the hype. So, the danger isn't AI. The danger is owning the wrong AI, the story stocks, not the cash-generating ones. The 3 mistakes that cost you the most. When a sector runs hot, investors make the same 3 mistakes every cycle. Avoid these and you've avoided the most damage. Mistake number 1, going all in on one theme. When AI is all anybody talks about, people pour everything into it. But concentration is how fortunes are lost. If your whole portfolio rides on one sector, and that sector corrects 30%, so do you. Diversification feels boring, precisely when it matters the most. Mistake number 2, buying because it's going up. It's already up 200%. I don't want to miss more is not a reason, it's a feeling. Chasing momentum is how people consistently buy near the top. The price goes up, and it tells you nothing about whether it's worth the price. Mistake number 3, panic selling. Panic selling the quality companies when it dips. That's the flip side. When the correction comes and the sectors always correct, the people who sell their good companies in the panic lock in the loss and miss the recovery. The Amazon investor who held through the 90% drop was rewarded. The one who sold at the bottom was not. Notice the thread. All three mistakes are emotional, not analytical. The market pays the calm and charges the panicked. So what to actually do? Here's the practical takeaway, not a stock tip, a framework. Number 1, decide how much of your portfolio you're comfortable having in any single theme, and don't exceed it, no matter how exciting it gets. For most people, that's a slice, not the whole pie. Number 2, if you want AI exposure, favor the businesses making real money today over the ones selling a story someday. A check of what multiple you're willing to pay for it. Number 3, assume a correction will come at some point and decide now what you'll do through the calm and how you'll do it. The plan you make in this quiet period is the one that survives the storm. You don't have to predict the top. Nobody can. You have to not be the person who's overconcentrated, chasing, and panicking, because that's the person the market takes their money from. So to close, is AI a bubble? Parts of it certainly are. Is the technology real? Almost certainly. Both can be true. And your job isn't to call the top. It's to own the right things and to keep your head when everyone else is losing theirs. If this gives you a clearer way to think about it, subscribe. We'll cut through the noise about the money every single week. And tell me below, do you think the AI is a bubble, a revolution, or both? This was Stocks at Sunrise. See you at the next one.